Hi everybody, Dana Sparks, broker of Maximum One Greater Atlanta Realtors, and today's contract tip has to do on the financing contingency in the RE forms. Now, for whatever reason, there's a lot of agents that refer to these forms as the FMLS forms, I guess because they're readily available in FMLS, but they're also available in Georgia MLS and some other MLSs. But anyway, please watch the video that I have done on the financing contingency. There's a lot to these financing contingencies, but I have just recently done one on the financing contingency in the GAR contract and why it has nothing to do with the buyers getting loan approval. And I did mention in that contract that I was going to do one regarding the RE forms. So I just want to do a quick video on the RE forms. So first of all, it is a little bit different, the terms of the financing contingency in the RE forms when a buyer and a seller go binding under those forms is a little bit different than when a buyer and seller go binding under the GAR or Georgia Association of Realtors contracts. So first of all, let me show you where the financing contingency information is spelled out in the RE forms. Unlike the GAR forms where any financing contingency is a completely separate exhibit, in the RE forms, the financing contingency, buyer and a seller negotiate through a financing contingency and an appraisal contingency on the contract itself, on the purchase and sale agreement itself. So that is RE 100, and paragraph 6.2 is the appraisal contingency, and paragraph 6.3 is the financing contingency. So in the contract, in and of itself, is where the buyer and the seller negotiate the time frame for that contingency, X number of days from the binding agreement date that the seller gives the buyer so many days to convince a lender to lend them the money to purchase the seller's house. And it goes on to describe the loan. So you negotiate the time frame for that contingency, and all it states in the purchase and sale agreement of the RE forms itself, it says this contingency shall expire at 11:59 p.m. on the day that is blank number of days after the acceptance date. And it goes on, you have to describe this contract is contingent upon the buyer's ability to obtain third-party mortgage loan, first mortgage loan to be secured by the property and it goes in and you fill in the amount of the loan, the interest rate, the length of years, so forth and so on. It does go on to say that if the buyer is getting an FHA or VA loan, you must attach an exhibit. But if the buyer's just getting a conventional financing, all you need is the purchase and sale agreement. Now, what happens if the buyer can't convince a lender, so forth and so on? That information is all described in the standard terms, which is Form RE1 of the RE contract package. It's called standard terms, and it is in the corresponding paragraph 6.3 financing contingency. And it goes on to explain that the contingency shall be granted by the seller, first of all, only if the box is checked, and subject to any expiration date expressed in writing in the contract. The financing contingency is defined as the seller's grant to the buyer of the right to terminate the contract if the buyer is unable to procure financing under the terms expressed in the contract. So, what does all that mean? What that means is it has nothing to do with the buyer's full loan approval. You're not going to get loan approval by any specified time frame. You're going to get loan approval, as I described in the other video, basically right at closing. That's the package that your closing attorneys are always looking for from the lender. The package is the full loan approval, the full loan documentation. So what is a financing contingency in a contract? It is a buyer and a seller. It is a seller agreeing that a buyer can terminate and will protect their earnest money if they cannot convince a lender to take the risk on them to lend them the money to buy the house. So in essence, it is just protection for termination. It has nothing to do with how the buyer is going to buy the house. I say nothing to do. Obviously, it has something to do with it, but that's not the primary purpose of a contingency in a contract. It is protection for a buyer's earnest money should, within X number of days from binding agreement date, they not be able to convince a lender to take a risk to lend them the money based on what they had described in the contract, in the financing terms of the contract. As I mentioned in the previous video, at least here in Georgia, I don't know how you do in other states, but at least here in Georgia, all contracts are cash contracts. When you go to closing, the seller doesn't have to wait for 30 years or 15 years to get their money. The seller gets all their money up front at closing. So in essence, all contracts are cash contracts at closing. So, I forgot what I was going to say. Basically, this is just protection. Oh, that's what I was going to do. So that's what I was going to say. If a buyer cannot convince a lender to lend them the money to buy this house, they have to send termination to the seller prior to those number of days, and they have to prove it with a loan denial letter. Now, there are a lot of differences between the more differences in the actual contingency exhibit and what a buyer and a seller agree to from GAR versus the RE forms. But in the RE forms themselves, just like in the GAR contract, they have to terminate by that certain date, and they have to prove it with a loan denial letter. The loan denial letter must be a denial of the loan that the seller agreed that they can try to convince the lender to get them, as described in the contract in and of itself. There are certain things that may not be on that loan denial letter, and those are all specified in the standard terms. And one thing that's a little bit different from the GAR contract is in the RE forms contract subject to financing, if a buyer is going to terminate based on not meeting a financing contingency, they must send that loan denial letter simultaneously with the termination. In the GAR contract package, a buyer terminating under financing must send the notice prior to that negotiated date, but then they have 7 days thereafter to send the loan denial letter. So that's a huge difference between the two contracts. But I also gave some tips and tricks and hints on points of practice that what you as an agent can do to help avoid any of these issues, to make sure these deals go through, to make sure there are no controversies or questions about a buyer being able to convince a lender to get their loan. What happens if a buyer pursues a different loan, so forth and so on. So please do check out that other video on the why a financing contingency exhibit has nothing to do with a buyer's actual loan approval. The one I did on GAR, I'll link below. Hope this contract tip helped you out. Dana Sparks, broker of Maximum One Greater Atlanta Realtors, satisfying your needs with service, innovation, and education. Bye. If you like that video, check out the one here. If you like the content on this entire channel, please click here to subscribe. I try to take even the most complicated of real estate situations and make them crystal clear. See what I did there? Real estate made crystal clear. Thank you guys so much for watching.